away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne, man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia Pacific and also U.S. futures under pressure as havens gain. President Trump ramping up trade tensions again, saying he will set unilateral tariff rates on multiple countries within weeks.
The president earlier declaring the trade framework with China is a, quote, done deal that includes rare earth shipments, but exact terms remain unclear.
Plus, energy and transport stocks in focus as oil prices holding on to massive gains with tensions rising over nuclear talks with Iran. Good morning. A warm welcome to everyone joining us right now. Lots to get through the next 2 hours or so. We'll start things off here with, as you can see, fairly cautious trading. There is a preference for haven place right now, slightly cautious start. Asia Pacific is effectively flat right now. U.S. futures are now down about 18 points, should be around session lows. And as you can see, gold is catching a bit. A lot of this actually coming through on the back of this headline and comments coming from Donald Trump earlier on. Within about a week and a half and 2 weeks, we might get more as far as information goes on tariffs. And of course, that also leading to dollar weakness actually across the board almost here in preference of the yen and also haven place. Right. The other big story, of course, is weak CPI, decent 10-year auction, a bit across treasury markets, and then we did get, of course, coming through the 30-year yield. And of course, we're now looking at 2 cuts price right now as far as Fed fund futures go. Flip the boards, please. It really coalesce around Fed expectations as well. So that's the story across the macro front. And we're looking ahead, of course, at a preview later on the 30-year auction coming through. Oil's a big story. Iran, and as we were pointing out as well, holding on to gains here. So you have Brent, you have West Texas, so give or take 5-6% from around this time yesterday, playing some catch up. As you can see, Shanghai crude is coming online, and we're catching a bit now. 7 days across Asia Pacific. Energy equities. Right, very, very quickly, as we go into the open today, and as you can see, the risk sort of aversion is permeating across futures right now. And one thing we're tracking, apart from dollar weakness, is the weakness in the Hong Kong dollar. And as you can see, we're very close now to the weak end of the trading bands. We're seeing some strength right now, but of course, that's one thing to track alongside many, including the weather, by the way, today. So perhaps a T3 tomorrow, according to authorities here. Yep.
There's a lot of graduations happening this week as well. That's been actually affected here by the weather, so it's really one to watch. But yeah, that T3 could be happening pretty soon here today. In the meantime, in terms of your agenda here today, so we're watching, of course, what's going to be happening in this briefing in Shenzhen. So possible talks of reforms and opening up. So we're watching very closely, of course, some of these Shenzhen stocks in particular. Then again, we talk about the energy price and what we're seeing with oil prices, and the geopolitical concerns around Iran certainly is something to watch here when it comes to the big oil names. Chow Tai Fook earnings on tap here later on, and we're watching very closely here when it comes to, is it really about the gold price that we're seeing this stock at 11-month high, or is there something about China consumption that we can kind of put some, I don't know, trends too. You take a look at when it comes to the window for credit data, FDI data as well, and of course PPI prices in Hong Kong coming out as well. You talk about those property stocks hitting that 1-month high. We just got that news of Season.
Yeah.
One of the first to really come out with a dollar bond offering here in years. Is that a sign now, maybe, Dave? Maybe there's a bit more appetite when it comes to high-yield bonds again in China.
And yeah, that's a good point. And whether this is really another financing option that has so far been largely absent and quiet for developers, right? So that's what we know so far. We'll see what demand and how much really they plan to raise as well in the dollar bond market as well. Right, 1-month high as far as the property markets go, as far as Yvonne was pointing out there as well. Right, back to the big news this morning. So President Trump has posted that the framework trade agreement with China is a done deal, and that will include upfront shipments of rare earths, but exact details of the pact remain fairly sketchy. Now, the president also says he will be sending letters to other trading partners in the next couple of weeks, setting unilateral tariff rates.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus. And you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries telling them what the deal is, like I did with EU.
Stephen Engel, our chief North Asia correspondent, is here. So, Steve, fresh off this tariff truce, we're hearing, again, stronger rhetoric coming out of the president here. What do we know about this?
You can't leave a day go by with no headlines, right? So we conclude the 2 days of those 20-hour talks in London with what he calls is a done deal. I think the Chinese response a little bit more muted to that, and I think there's some maybe disagreements, especially among investors, about whether the U.S. narrative sounds like it's if China does this, then we will do this. The onus is on China to make the first move on relaxing or speeding up the export of those critical rare earths. But we'll get to China's response in just a second. On this unilateral reciprocal tariffs, the deadline for everyone except China is fast approaching in less than 4 weeks on July 9th. But now he is saying, Donald Trump is saying that he intends to send those letters to those key trading partners within the next 1 to 2 weeks. Essentially, we cut that soundbite off a little bit. He says, at a certain point, we have to say, this is the deal, you take it or you leave it, is what he said. And again, we don't know what kind of leverage this will exert on its trading partners. And there were a lot of countries and economies that got those unilateral reciprocal tariffs individually, like Vietnam, 46%. But again, he singled out countries like Japan, South Korea, India, the EU, at 15 economies he mentioned. So I think it's changed a little bit since Liberation Day. They are prioritizing key trading partners. And where does that leave all the others as the deadline comes fast approaching?
And where does that leave the deadline, right? If you're talking about 2 weeks, right? Working letters.
Moving goalposts now, and he's had a history, of course, of moving the goalposts before.
Yeah. You mentioned about the China response so far has been muted. What exactly did we hear in that readout?
Okay. Huang, as quoted by CCTV, said the two sides should now show the spirit of good faith. We do have a graphic. We can see what Huang, the vice premier and lead negotiator, had to say. The two sides should show the spirit of good faith in abiding by their commitments and jointly safeguarding the hard-won results of that dialogue in London. The statement did not elaborate on the specifics of the framework. The United States, as Donald Trump and Howard Lutnick and others, Scott Bessent, Jameson Greer, have basically said they expect upfront deliveries and the speeding up of the licensing and export approvals of these key rare earths to the United States, especially the things like terbium, dysprosium, samarium, which go into industrial magnets for the aerospace, automobile industry, defense industries. They hold their magnetism through high heat. That's why they're so special, right? China's got this lever of negotiation now. The United States needs them. And one thing that's very interesting, and if you have a chance, go read Jennifer Welch's article on the Bloomberg terminal. She's with Bloomberg Economics in Washington, D.C. She really breaks down the kind of leverage that China now has, because they basically set up this export licensing mechanism that they're not going to dismantle overnight, because things could go pear-shaped again, right? And what this does, this export licensing mechanism, basically requires U.S. orders to show what they're using them for, all the details of the supply chain. All that information is extremely valuable to China. They're not going to be dismantling that anytime soon. So there's a lot of interesting geopolitics going on, and intelligence gathering as well through all of this. I've only scratched the surface of the whole deal. Now we have to kind of see where this goes from here. Does China speed up the licensing process? Does the United States in turn or simultaneously back off on its more recent export controls?
Steve, thank you. Stephen Ingles, there, our chief Northeastern correspondent. And really for more on what this means for markets, let's bring in Mary Nicola, our Bloomberg MLI strategist. She joins us live from Singapore this morning. It seems like this trade uncertainty is reemerging once again. Mary, what's your read on it so far?
Yeah, absolutely. I think the comments that Trump made this morning in terms of about unilateral tariffs, we're still trying to make sense of it and what it means for markets. But one thing that has been clear is that the U.S. dollar remains the punching bag for investors, where every time you get these headlines on trade, the dollar sells off, and a lot of the currencies, especially in Asia, benefit. And we're seeing the Thai baht, the Malaysian ringgit just accelerating as a result. And it really is a fact that a lot of these comments are undermining the dollar. They're undermining the U.S. the sell. They're highlighting the Sell America story even more so. And I think that trend is likely to continue, especially if we continue to get these headlines that we're still trying to make sense of, where investors are reacting now of sell first and ask questions later.
Mary, two other things are at least on the agenda today. One is current, one is coming up in a couple of hours. There are tensions again in the Middle East. We know oil prices and the bid that we're seeing in that part of the markets. And of course, we also have the 30-year Treasury and the auction coming through around within the next, let's call it 20 hours or so. Which one do you think is going to be more material to markets?
Yeah, I think the 30-year Treasury is going to be quite critical because we had the 10-year and that went through quite smoothly. And then we saw how CPI, we're not seeing really the impact yet of higher tariffs. So what is the trajectory for a 30-year? We know that the long end of the bond market has been under pressure and under scrutiny for quite some time because the focus has been on fiscal sustainability, whether it's in the U.S. or in Japan. And we saw in Japan how the 20-year auctions, the 30-year auctions and the 40-year auctions weren't very well received. So if we look at this time around in the U.S., this is going to be a key barometer of how investors are viewing fiscal sustainability, how they are seeing the longer end of the bond market. So I think that's going to be absolutely critical, and they might look through what we saw from CPI and just focus on the debt sustainability and the fiscal dynamics, especially since we're seeing the Senate, they're still undergoing talks and there's no real key changes in terms of cutting spending. And we heard from Scott Bessent today highlighting that he expects the fiscal deficit to reach around 7%. That's still quite high, and that's going to be on top of investors' minds.
Mary, thank you so much. Mary Nicola there in Singapore for us on the Treasury story, I guess in some ways the dollar story too. In fact, just on that coming ahead here on the China show. So JPMorgan Private Bank is coming through as well. So one of their conviction calls is higher on the 10-year yield, but contrarian view, a stable U.S. dollar from here. Julian Wang joins us at about those times on your screens for her thoughts and, of course, the broader market stories as well.
Yeah, but coming up next, we're going to talk about, EU-China relations and really what does that mean when it comes to students really studying in China. We've got Frank Bournois there from CEIBS, the school dean, joining us next. This is Bloomberg.
Right, welcome back and good morning. You're watching the China show. So back to our top story here. It's certainly one of the outcomes from the recent iteration of the trade talks between the U.S. and China in London appears to be that Chinese students will again be welcome in U.S. universities. In a post on Truth Social, the U.S. president says China's agreed to supply rare earth materials that are then used in a wide range of consumer goods. In return, he says, quote, "We will provide to China what was agreed, including Chinese students using our colleges and universities, which has always been," he says, "good with me." And this really highlights the broader conversation around people exchanges, right? In one way, you have foreign students and sort of the rather, let's put it, unwelcome environment or conditions recently, at least relatively speaking, and of course what that means for the other side of the road in terms of the foreign cohort of foreign students in mainland China. In fact, just on that very note, let's bring in Frank Bournois, Vice President and Dean at the Shanghai-based China-Europe International Business School, otherwise known as CEIBS. Good morning. Nice to see you.
Good morning, and thank you for having me.
You guys are in a very unique spot as far as the perspective you guys bring in terms of what you're seeing as far as foreign student flows into China. Tell me what you're seeing at CEIBS.
Well, you see, in business education, we are really thinking long term, and we are looking at the situation. So it's of course very special times in the short term, and maybe there are less foreign students in China in business educations, although we see in the very recent past an upturn of applications.
From where? Can you tell us a little bit more about, because it seems like right now the trend is not that as appealing now to find a job or a career in China if you are a foreigner. What are you seeing in terms of the pickup in numbers then?
Well, I think we have very clear trends of maybe less, of course, from the US. But I mean, in this very big world, we've got rest of the world, we've got the EU, Europe also, which is catching up, and there is anyway the internal Chinese market.
Yeah, full disclosure, I went to CEIBS, and when I was there 15 years ago, the allure was of an education in China was really learning about the Chinese market, foreign companies expanding in China. 15 years on, it's almost not the opposite, but another trend has reemerged: Chinese companies going abroad. Right. Tell us what you're seeing there.
Yes, I think you are very right, David. I think that now we have a mix of the two, which is clearly the school in its mission is to develop talents from Chinese companies globalizing, and from, of course, still international companies and leaders needing development for understanding the access to Chinese markets. And this is very, very true. We see this both in degree programs like the very traditional MBA that you know, and also for executive education.
And this is at a time when you are talking about, Chinese are facing barriers in the EU when it comes to automakers and the like. How do you see kind of relations between EU and China, and how do you think it's going to impact your line of work now?
Well, I think, again, in this world, we need to be looking long term. The school is top of list with many other leading business schools in this world, and there are many things that are close between China and Europe because of the culture, and it's not a geopolitical thing. What I think at CEIBS, what we do, and of course we are a China-Europe international business school, which is a very special school of its kind because it's a joint venture between the European Union and the Chinese government. Yeah. And what we want is to develop talent. And of course, you do not develop talent in 1 year for tomorrow morning. And I believe for sure that globalization will be going on. Many reasons for this. And of course, if you look training, developing talent, it's something like 5 to 10 years. And if we have to do this now for any country, because there will be, as you know, 50% of trade activities has to do with intermediate goods. Right. So that's being very hopeful. And what is happening now, I think, is contextual. We will come out of this, but if we do not now, in leading business schools like CEIBS, prepare future leaders, there will be a problem tomorrow of another kind.
You bring up a very good point. Some of the mega trends that have emerged because of, I guess, the rivalry between the U.S. and China have been, China's doing more trade with the global South, with Southeast Asia, with Europe is a good example of maybe perhaps fresh opportunities for fresh markets for Chinese companies to expand into. How does that affect your strategy as a business school in terms of China's trading links with other parts of the world? I know you have a new program, of course.
Yes, I think it does affect it in some ways because, of course, what we want to do before anything is develop the best people that can be working later for leading international companies, be they from Europe, the US, rest of the world, as you said, or even Europe. There are 13,000 business schools in this world. There are 5 million business management-related graduates every year coming out. And this is why, when you stand in the top list, in the top 10 of those leading business schools, you have the duty to provide best talents, not just for companies. It's not for the nations only, but it's also for the great people who sometimes come from different national horizons.
The allure of, or the value of, let's say, an MBA, the perception isn't what it used to be it's changed. AI is coming. You could, you learn things. And I wonder how you keep the program relevant. You mentioned 13,000 business schools.
Yes.
You mentioned you have to be at the top of that list. It's not a cheap investment, for example. So what's the case for a master's degree in business admin at this point in time?
I think that business education is very necessary, first for people who are coming from another bachelor degree. If you're coming from engineering, if you're coming from the medical sciences, if you're coming from the legal side of education, then you need the fundamentals, the pillars of management, finance, human resources, leadership, marketing, AI now with the transformation it implies. So there is that necessity to be updated. What is true is that there is obsolescence of learning. What was true in the past for 30 years, lifetime career, is no longer true for as long as this. And so there is permanent, constant need to update. And this is why, in that context of trade, where we made the decision at CEIBS that we would offer admissions to students who now, in the contextual environment of the US, would not be admitted or would have problems with their enrollment.
Interesting.
So we would be immediately making an offer, and we are making an offer to very good students who got admitted in the US top 30 Financial Times list, and they're going to be able to join us and join other great international students.
You've gotten some inquiries on that already?
Pardon?
You've gotten inquiries on that from US students?
We have had some applications, and that's an offer we're making, as we would be making to any other part of the world if talents, obviously, being admitted to great business schools, would also want to continue with us.
Frank, we're going to leave it there, but thank you so much. Frank Bournois there, Vice President and Dean at the China Europe International Business School. We got plenty more ahead. This is Bloomberg.
Right, opening bell is just over 3 minutes away, and it's a cautious start to the session ahead. Declines, as you can see, across the board. Plenty more ahead.
Welcome back. You're watching the China Show. We are counting down the open of markets here in Hong Kong, Shenzhen, and Shanghai. And we're seeing a little bit of pressure across equities here this morning. This on the back of this fresh news from President Trump saying that he will set unilateral tariff rates within 2 weeks. So once again, trade tensions are back on the forefront of investors' minds here. Futures are lower here, and we are seeing 719, a little bit more in terms of that weakness in the dollar here, Dave.
Yeah, which really accelerated when that announcement came. Those comments coming through at about just before 7 in the morning here, Hong Kong time. And apart from that, other things, of course, the Hong Kong dollar remains on near the weaker side of the bands. That's obviously quite reversing right now because of the dollar weakness coming through. And the top of the next hour is this briefing on the opening up and further reform of Shenzhen coming through. We'll get to that later, of course.
Yeah, it seems like at this point, the latest headlines are kind of overshadowing some of the optimism that we saw in terms of this U.S. and China sort of positive tone that was struck in London as well. But take a look at how the onshore markets are doing. We're lower by about 1/5 of 1%. You're not quite seeing a clear trend on what's really going on, but it seems to be that Shanghai and Shenzhen are heading lower this morning. Commodities are on offer. Take a look at steel, take a look at copper here right now, and we are watching some of the consumption names. Look at Midea Group. We're down some 4.5%. Not sure why. We'll continue to watch that one, but Quaychow though is flat this morning. You flip the boards and take a look at what's going on in Hong Kong. We talk about these bull markets. Looks like we're coming off that right now. HS Tech is leading that charge lower here this morning. We're seeing declines of more than than 1% on the tech board there. Tencent, Alibaba is down 2%. Baidu are all lower here. So certainly it is, once again, these tariffs that are really kind of weighing on investors' minds. MSCI China also lower this morning. So the property stocks are one thing to watch as well. So we've seen actually a bit of a rally here. I mean, there was news that in our sources talking about this so-called Provident Fund to help with some of these property developers. That certainly had led to a bit of a rally recently. We also got news of Season, right? So this is the private developer now, for the first time in years, been able to offer high-yield dollar bonds back in this market. So certainly the demand picture is certainly one thing to see, whether there is appetite for these sort of high yield bonds. But there you go, Season. It was initially up in the pre-market. We are now lower by about 1%.
Yeah, speaking of bonds and speaking of demand for bonds will be very much in focus when the 30-year Treasury auction comes in within the next 24 hours or so. So we're coming off a decent 10-year soft CPI. Fed pricing's gone to 2 cuts, coalesced with Fed dots, and the 30-year bond yield's coming up on your screens very, very shortly, catching, I think we're slightly lower in that as well, but certainly when you look at bid to cover, the last auction I think was May 8th Asia time, and bid to cover there was the lowest this year so far, at a yield which was relatively on the higher side, not the highest so far, but yeah, just to give you a sense of bid to cover the last 2 years or so. And as you can see, this one actually took us all the way back to the summer of last year. Now, speaking of bonds, interestingly, almost this time yesterday, our colleague Eric Schatzker at the Bloomberg Invest Summit that took place yesterday put a yes or no question to the CIOs of Standard Chartered and also Bank of Singapore about U.S. Treasuries. Have a look.
Yes or no, should investors still think of U.S. Treasuries as risk-free assets?
No.
No.
There you have it, ladies and gentlemen. Steve Rice, Junshi Bio.
Yeah, Bloomberg has learned that Hong Kong's pension fund managers plan to sell their Treasury holdings if the U.S. loses its last recognized top credit rating. For more, we're joined by Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu. Also with us is Lulu Chen, who leads our Asia investing and real estate coverage. I'll start with you, Lulu. Just tell us a little bit more of the latest, and how do you think these pension funds are going to be responding to what we've been seeing in the Treasury market?
Sure. So sources told Bloomberg that the pension fund industry yesterday had a meeting with regulators. They have proposed to sell down U.S. Treasuries if they lose that last top rating. And they've also done an impact analysis on what that means for these fund managers.
What's the regulation behind all of this? So what's the mandate that they need to abide by?
All of this is happening because, as you know, a few weeks ago, Moody's downgraded U.S. Treasuries. And so right now, only one rating agency in Japan is rating U.S. Treasuries AAA. And Hong Kong has unusually stringent regulations requiring that these pension funds not hold no more than 10% in their portfolio of U.S. Treasuries if it loses that AAA rating.
Stephen, your take on this and what the impact could be?
It's not really a game changer if you ask me, whether from the perspective of U.S. Treasury market or from Hong Kong currency and FX rates market. So for U.S. Treasury, when we look at it, the Hong Kong pensions, all the assets together, we're talking about over $160 billion US. Even all of them are in U.S. Treasuries, and they sell all of them. It doesn't move the needle. So U.S. Treasury, we're talking about almost $30 trillion US market. So even if they sell it, well, they're not going to sell all of them. It's not going to move the market. But structurally speaking, that's actually the trend that we are seeing without the regulations. Everybody, central banks, sovereign funds, they may think about at least reducing the holding share of U.S. Treasuries because of what's happening with the trade war, with the U.S. administration. So that's bound to happen with or without this regulation change. And for Hong Kong, of course, if they really sell U.S. Treasuries, then you can expect demand for Hong Kong dollar, for Hong Kong liquidity. So we're going to see a rebound in the currency and high highballs. But even without that, also, as we have seen, it's near 785. So HKMA will be ready and step in to drain liquidity. So rates and FX will rebound regardless.
Okay. Well, is that positive carry still a doable trade now on the Hong Kong dollar or forwards, given that we're very, very near to the weekend of the trading?
Not necessarily, because whether we talk about spot carry or forward carry, it's very attractive early May before HKMA came in. But now all of a sudden, like, the carry is actually sort of disappearing. So if you go in now, you're just looking for that real little carry, but you have the risk of dropping all the way to 775, which can happen. So I think now traders are staying out of the picture. Either they're taking profit or they'll just wait until 775 again.
Lulu, you mentioned about the regulations and how it's rare that they're so stringent. particularly in Hong Kong. Other pensions in different countries, they usually have U.S. Treasuries almost as an exception.
Yeah, there is a bit of leeway, but like Stephen said, while this is creating a headache for pension fund managers, it's not expected to rock U.S. Treasuries given the depth and the liquidity in that market.
Is there talk of loosening those restrictions at least?
That was one of the proposals, but as of yesterday, what we've been told is that most likely the scenario is they could keep it at 9%. So just trim down a little bit and not completely sell. Yeah.
All right, folks, thank you so much. Stephen Chu there, our Bloomberg Intelligence Chief, Asia, FX, and Rates, and of course, Lulu Chen, who leads our Asia investing and real estate coverage. It brings to mind have you seen Mission Impossible?
The new one?
The new one?
No.
So there's almost this, I think Tom Cruise did this joke, I forget which talk show it was. You know, he does his own stunts, right?
Yeah.
And you know, this U.S. Treasury thing, oh, there's a standard, it has to be AAA, but then they remove AAA and then they go like, oh, treasuries are still safe. So this is going to make sense in a moment.
Waiting for you to explain, yeah.
So Tom Cruise basically did this joke where he was, here's the stunt to his safety guy. And his safety guy somewhat went, oh, that's not possible.
We can't do it.
Can't do it. So what he did was, let's get a new safety guy.
Oh, I know.
Moving the
goalposts.
goalposts.
Okay.
I didn't quite deliver it.
It's okay. I get what you mean.
Thank you so much.
Okay. Quite a stretch, but yes, I get it.
Yeah.
You can get an insider's guide to the money people shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up through the website, bloomberg.com/newsletters. Plenty more ahead. This is Bloomberg.
Right, welcome back. You're watching the China Show. Here are some of the big geopolitical stories that we're tracking at this point in time. So the Trump White House has launched a review of the Biden-era AUKUS military pact here with Australia and the UK. Now, the Pentagon says it will study whether the deal aligns with Trump's America First agenda as it shifts the burden for collective defense to its allies. Now, the 2021 deal involves the U.S. selling Australia up to 5 Virginia-class nuclear submarines as the allies develop a new next-generation sub. Now, UK Finance Minister Rachel Reeves has announced a funding boost for health, defense, and infrastructure in a spending review seen as a watershed moment for the Labour government. Now, the NHS will see a 3% rise in spending in each of the next 3 years, amounting to about $39 billion. Now, Reeves also confirmed that tens of billions of pounds of new funding for infrastructure and public services.
We are renewing Britain. I know that too many people in too many parts of our country are yet to feel it. This government's task, my chance, a task as Chancellor, and the purpose of this spending review is to change that.
All right, particularly when it comes to oil prices here this morning, we continue to see geopolitical tensions really elevating the price here. And we saw WTI overnight actually see that pop of some 5%. We're seeing similar moves when it comes to Brent markets here this morning. This in the back of the U.S. now is considering withdrawing some embassy staff from Baghdad and allowing military families in the Middle East to leave voluntarily, despite not specifying what threat has prompted the moves. But President Trump has told the New York Post he's less confident about successful negotiations to impose new limits on Iran's nuclear program. Let's bring in Bloomberg's senior editor, Derek Wallbang. Tell us, first of all, bring us up to speed, Derek, on why we're at this point, and what does it tell us about where these nuclear talks are going right now?
Well, let me start with the last part of that. This is an escalatory step that you would take if you think that there is a possibility that things could go sideways. It is not always an indication that that will happen, but it tends to be something that you do as preparation for just-in-case scenario. This would be a sign that the United States thinks that there is an increased possibility of, candidly, of just bad things happening in that part of the world. Again, doesn't mean that that's that's going to happen, but an increased chance nonetheless. We saw the United Kingdom issue a notice to mariners to be extra careful when going through the Strait of Hormuz. And we've also seen oil prices rise in response to generally sort of escalating tensions in that sector. So I think all of those sort of together kind of paint a picture of some tangible outflows of an expectation of increased tensions there, as the U.S.-Iran talks really have not kind of gotten anywhere tangible yet. You did see, as you quite rightly mentioned, Trump express some doubts about where those talks are headed. There are a lot of ways to say no before you can get to yes, but this is a very fraught relationship between the U.S. and Iran. There is not a lot of underlying trust, particularly between Iran and the Trump administration. And we are seeing, as I say, some tangible signs of tensions rising across the region.
And Derek, get us up to speed on the premise. What is exactly happening or not happening with talks?
Well, look, David, I think the key thing that everyone has to remember is that there was a nuclear deal between the United States and Iran, and Trump didn't like it and pulled out of that, and you start sort of there, right? So there is a foundational, not a lot of trust there. Now Trump has said, and the administration has long said, that they want Iran to not have nuclear weapons. Iran has said that it wants to have some peaceful enrichment. The Trump administration says it wants to have no enrichment. The question of enrichment has really been one that has kind of bedeviled this. It's a sort of area where you see the seeming red lines from both sides in contrast, and that becomes a difficult point. At the same point, there are other actors in this as well, right? Israel has its own thoughts and needs there, sometimes wants to push more aggressively against Iran than the United States is comfortable with. But that Israel-Iran relationship is a different thing. And then Iran has its own relations with its own neighbors that, we don't have time for, thousands of years of Middle East history, but that, suffice it to say, it's quite complicated there. I think the thing that is important to note when you're talking about from like an Asia perspective, watching this very much as most of our viewers are right now from thousands of miles away, is you look for tangible steps. And the tangible steps that we're seeing this morning are oil prices going up, the UK notice to mariners, and a U.S. indication that it's allowing some families to leave nearby embassies. And so all of that tangibly says to you that there is a bit of an escalation in tensions. Now, whether that becomes anything more or less very much remains to be seen. But the thing that I always watch for on this, when you have mountains of bad feelings on all sides, is to see where those tangible steps are at any given moment.
Derek, thank you so much. That's a setup for why oil prices are continuing in the front foot. Of course, the bulk of the move so far, the last, let's call it 48 hours, was really going into the cutoff this morning in Asia, but still seeing, of course, incrementally more gains. In fact, we just showed you, there we go. We're up 3.5%. That's the Shanghai contract, bottom of your screens. Let's call it 6-7% over 2 days on Brent in West Texas. For more on how energy markets are reacting specifically to these renewed tensions or new information, Stephen Stapczynski, who leads our Asia energy coverage, is with us right now to give us more context on these prices. So, Stephen, the markets are understandably reacting, but is this an overreaction? What's the sense on the ground now?
I mean, overreaction, underreaction. There are two factors that move the oil market so far this year. One, Trump, and two, OPEC. So we've got Trump coming out and saying something about, whether an Iran deal is going to happen or whether it's not going to happen. I think you could argue that this is potentially an overreaction because I think Iran's response so far has been pretty they've been very careful with their words. They said if a nuclear deal doesn't happen and if there's some sort of strike, then we're gonna have some problems. I think we've seen in the past there have been kind of tit for tat strikes between Iran and Israel, and you've seen oil prices rise and fall based on that. But you haven't seen a targeting so far of any of Iran's oil infrastructure. You haven't seen a real specific drop in any of the output from Iranian fields. So it's too early to say exactly what the impact would be. This is really, I think, the movement in the market. It's traders positioning for some sort of potential action. But I do want to preface all of this with the flows of oil and production and the trade hasn't been disrupted yet. So until that happens, until there is a physical impact, oil prices will continue to be pretty volatile in this up and down sort of direction as we're in $60 range for Brent. Now, I think one thing that is harder to understand is how Trump reacts to all of this. He's so unpredictable that whether this is a correct reaction or not correct, in a few days, the people who sold now or bought now could be vindicated. So it's really challenging to tell.
Yeah, interesting, especially with the UK Navy coming out with that rare sort of announcement warning about how this might actually impact shipping and the Strait of Hormuz, which has been that choke point for oil. Stephen, thank you. Stephen Sapchinsky there, joining us with the latest on what this means for oil prices. So right now we are taking a look at, there are some new lines coming through from CCTV when it comes to the car makers. So China is to guide car makers to foster stable supply ties. Of course, this on the back of these price wars and what we've been seeing so far as well when it comes to some of these car makers there, Dave.
Yeah, and also, I think the parameters to dealing with their supply chain amidst the fierce competition. This is quite telling because I think, well, at least for today, we are seeing some fairly sharp moves. Look at XPeng down about 6%. Now, whether or not this is tied to what's happening today or more broadly, that's a separate question altogether. Now, a survey, in fact, let's get more on this roughly. A survey by Bloomberg Intelligence has found that over 64% of car buyers are opting for NEVs versus about 57% last year. That's mainly driven by an interest for plug-in hybrid. To tell us more on this, let's bring in our Bloomberg Intelligence China auto analyst Joanna Chen joins us here on set with the key takeaways from this new car buyer survey and what the new preferences are.
Yeah, so our car buyer survey serves as a lead indicator to show how consumer preferences and trends are evolving across markets. We do that in China, Europe, US, and Japan. So basically, yes, electric vehicles are still popular in China. We see the numbers, 64% versus 57% last year of the percentage of our survey respondents saying that they're going to choose new energy vehicles. But if we break down the numbers, it's a little bit more interesting. So for battery electric vehicles, it still takes the lead, about 1/3 of respondents saying that they want to choose battery EVs, but if we compare it to 2024 results, that's basically flatline. What's really driving the growth is the plug-in hybrids. So that tells us that consumers are still a little bit worried about the battery charging concerns and the infrastructure. Until that gets ramped up, automakers, the best strategy is to have a strong and balanced portfolio in both battery electric vehicles and plug-in hybrids so that they can address to a broader customer base and they have the potential to win more market share.
Tell us about the competition. What are the most popular brands this year, and how has this list changed versus just a year ago?
Yeah, we definitely saw some reshuffling. We asked the buyers which brands are you most likely to choose. So in general, local brands are gaining ground versus foreign brands retreat. We see in our results that this year BYD climbed to the first place and Tesla slid to the second. What's really interesting is Xiaomi. Xiaomi ranked number 4th in our 2025 survey with votes only marginally below BMW. So actually this kind of brand popularity is not fully reflected in Xiaomi's sales number yet. Consumers, they are waiting for 11 months to get a car from Xiaomi.
Wow.
And the sales are capped by production capacity, and when Xiaomi ramps up its second factory and also with a new SUV model, that puts Xiaomi into a very serious competitive position that will pose more threat to existing EV players.
Before we brought you in, we talked about this. There's this news line from CCTV. China's guiding car makers to effectively, well, the word they use is foster stable supply ties. I think yesterday, XPeng issued a statement on the 60-day bill payment for suppliers, standardizing that plan. I'm wondering if you could tie those two news lines in to the broader competition that we've seen in the last 2 years and what the damage is to branding, really, because of what's going on.
Yes, we definitely also tell from our survey results, because of the more than 2 years of price competition, consumers, they don't have much brand loyalty anymore. So they are really focusing on what the products can offer me. Is it like the specs, the pricing, the software? You have to be good so that I will buy your products. So automakers don't really have any pricing power at this time. It's consumers who make decisions. And actually, the Chinese government putting more scrutiny on the like supply chain stuff. It's kind of like they try to bring the auto industry into a more like healthier direction of development. At the same time, competition is not really going away until the markets become more consolidated.
All right, Joanna, great stuff. Thank you so much for bringing us that report. Joanna Chan, Bloomberg Intelligence China auto analyst here. Coming up the next hour, though, we'll discuss market strategy with JPMorgan Private Bank. Julia Wang saying, look, the dollar could actually stay steady from here on forward here. We also talk China consumer with Macquarie Capital's Linda Huang. Plenty more ahead. This is Bloomberg. All right, some movers. We're going to talk about AI-powered smart glasses. Yes. So CCTV has been reporting that they've seen the sales of these products have had, quote, explosive growth. So we are seeing quite a bit of price movement here today, talking about how it's really the sales have increased more than 8 times previous levels.
Yeah, 2.7 million units in 2025. I wonder if that's indicative of adoption of technology or just bad trends when it comes to eyesight. Anyway, right?
Could be both.
Could be both, actually. Could be both. As long as technology allows us to function, I think is the key. It's the key word here. Glance at markets. The second hour of the China Show is coming up.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. Yeah, we're seeing
Gua sha. I need gua sha on my face.
Yeah, a lot of I'm working on my Beijing accent. Now you take a look when it comes to how markets are doing here right now. We talked about the pressure, but it's quite marginal. We're seeing onshore markets here right now. We're seeing a little bit more downside when it comes to Hong Kong and MSCI China. Just given we talked about it's once again trade tensions, right? The fact that President Trump is talking about sending letters to countries about these unilateral tariffs that they might be receiving in the mail in about 1 to 2 weeks.
I'm already confused because I think Steve, who will be joining us in a couple of minutes, talked about, I think it's July 9 and August 12 were the dates to watch.
Yeah, what do those dates mean now?
Yeah, well, that's the point. I don't know. And we're inserting more potential landmines for markets within the next few weeks or so. As thing is, to consider. It's hard to. I guess equity markets have rallied so much that it's hard to see how they can continue to do so with the levels they're at, with a slowdown happening. You look at the data, right? Inflation in the U.S. came in softer than expectations, and with potentially the same level of certainty.
The impact of tariffs yet, which was quite surprising in that U.S. inflation print.
Yeah, not yet.
Not yet.
Yeah, I think there's a good piece on the terminal right now that talks about why it hasn't showed up.
Yes.
Just yet. In any case, of course, we'll talk more about that, and of course, I think we'll probably get a better indication with the 30-year auction coming through, but that's it's about a day away, so I think lots can happen still. Pharma stocks, we're looking at that on your screens coming up very shortly, and there we go. So the Junshi Bio, actually. So that's an interesting story. So there was I'm trying to find it. There was a statement that put out to the exchange that it did receive, I think it was approval for clinical trials for a monkeypox vaccine.
Yes.
There we go. So it's up 5%. I'm not making that up. Actually, I just remember the top of my head. We're down 0.7% on the Hang Seng Index. It's also good to keep in mind that most of the benchmarks, as we flip the boards, please, are now in a bull market. Hang Seng, MSCI China, Hang Seng China, and of course Hang Seng Tech. I think we're on the Hang Seng Index, we're within about 2% of that high that we hit back in early April, or in March actually. But yeah, we can talk about that a bit later on.
Yeah, broadly speaking, we're doing this here right now, right? So bonds are actually bid up leading up to the 30-year auction in the U.S., so maybe a little bit less angst this time around. But certainly the demand picture for long end treasuries is certainly still up in the air of what people are still talking about, right? I think it was Goodlock that just said that there's a reckoning that could be happening when it comes to the debt problems in the U.S. as well. But let's get back to our top story. President Trump has posted that the framework trade agreement with China is a, quote, done deal that will include upfront shipments of rare earth materials. But exact details of the pact remain real sketchy right now.
Yeah, the president also saying he'll be sending letters to other trading partners in the next couple of weeks when it comes to setting unilateral tariff rates. In fact, have a listen.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries and telling them what the deal is, like I did with EU.
For more on this, let's bring in our chief North Asia correspondent, Stephen Ingles. Also here in town is John Liu, our Greater China senior executive editor. Steve, I'll start with you. How is, these unilateral tariffs could be coming in days, weeks. How is it going to coincide with this deadline of June 9th?
Yeah, well, I think
July 9th.
Deadlines are negotiating tactics, obviously, and he's changed the deadlines before around the reciprocal tariffs, around Liberation Day, and a number of different dates have changed depending on how negotiations have gone. And so essentially the 2 dates we are circling on the calendar are July 9th for the reciprocal tariffs resumption following the 90-day pause. That's on everyone else except China, essentially, that they added reciprocal tariffs. He mentioned 150 of them or so, and that they're going to concentrate on maybe 15 of the main trading partners. I mean, I'm talking in isolation from China. China's a different timeline. I'll get to that in just a second. So you're talking about India, South Korea, Japan, the EU he mentioned, which might be a little bit more tricky situation. But then it raises the question, what about Vietnam that got labeled or slapped with that 46% before the pause? So there's a lot of other economies that are kind of going, well, we need to negotiate as well. The time frame makes it a little bit more tricky because it's less than a month away. All right. China got a 90-day reprieve following the Geneva truce.
Yes.
Sorry. And that expires August 12th. So that, it looks like, as Howard Lutnick told, I think it was Fox News this morning, essentially we're in a super place with China right now. Obviously, there are major issues with China still to be had, but the other economies are stuck against this time frame, which could obviously change as well. Changing goalposts, distance and laterally.
Well, so this time yesterday we were talking about the initial statements that did come out of the London talks. What's been the response so far, 24 hours from that point in time from the Chinese? What more do we know?
Well, I think the Chinese are being a little bit more measured. I mean, there was a statement coming out. Well, first of all, Li Changgang, who's one of the main negotiators, the vice commerce minister, did come out with some comments yesterday, actually before Lutnick and Greer, essentially saying they had reached consensus and that they needed to hopefully are conducive to building trust and the like. Now we have statements through CCTV, state media, from He Lifeng, the vice premier, essentially saying we need to follow through on the guidelines given by the phone call between Xi and Trump. And he went on to say, there's the quote here, two sides should show the spirit of good faith in abiding by their commitments and jointly safeguarding the hard-won results of the dialogue. However, he did not elaborate, at least in the readout from state media, on the specifics of the framework. Yep. But again, if you saw the U.S. Statements, and everyone's talking. I mean, Howard Lutnick's been on CNBC, he's been on Fox News, Scott Bessent has been testifying before the Senate, all saying the similar thing, and that is, okay, we're ready to remove our more recent trade export curbs if and when we get those license approvals, expedited approvals for rare earth and rare earth magnets, which Donald Trump says are going to be front-loaded.
And John, it's interesting, right? I think maybe the Chinese are learning this in these trade negotiations, that we thought these export curbs were, red lines for the U.S., but now they're actually negotiable.
I think this is a very interesting new phase of these talks because what used to be trade and national security is now ever increasingly the same thing. And I think this is what Beijing wanted. Like Beijing would like to have a grand bargain where all the stakes, all the cards are out on the table, and we reach some agreement about how the United States and China get along with each other. I don't think, at least under Biden, the U.S. was not interested in that. The U.S. wanted small yards with high fences, right? And it seems like that position has changed, at least under Trump.
I mean, including Chinese students in the U.S., I think, part of the conversation, I think, based on the latest post from the U.S. president. I mean, with more parameters in place, does that make a grand bargain as opposed to a specific trade deal harder to achieve, I guess, is the point?
I think it certainly does. I think it, we had the phase one trade deal in the first administration. I could see it coming in, step by step.
Right.
And, sort of London leading to some other talks in some other city that bridge another gap, and then you get so we could be in talks for years to come. But I think there is incremental progress that both sides want to achieve.
Yeah, and I think the fact that they got on a phone call, I think, was something that was largely unexpected last week, and then it happened, right?
And even with rare earths, though, I think the Chinese are also learning that this is their ultimate weapon, right? That this is what they need to keep very close, this card that they have.
I think it's, I think they certainly see how powerful it is. I think, though, there is a recognition in Beijing that the more you play this card, the more you motivate other countries to wing themselves off of China when it comes to rare earths. And so, one, that's not going to happen overnight. People need to build mines, they need to build refinery capacity, they need to do lots of things. But if Beijing is going to hold this over trading partners or competitors, it's going to motivate people to build those mines and build those refineries.
But if I can jump in here, that takes a lot of time. So China does right now have a major leverage. As well, they've realized that they've put together this their own export control framework, which they're very unlikely to dismantle because of a truce. We saw how quickly the truce from Geneva unraveled because of bad blood, if you will, and also just a misunderstandings between the two sides on what they're ramping up and what they're not dialing back, right? So I think that's going to be in place in case the relationship gets worse. And there was a great comment yesterday from Jeff Moon. He's a former assistant U.S. trade representative in charge of China. He said the fact that the Chinese are using the word they've reached a consensus. Yeah. When the Chinese say they've reached the consensus, that means we're closer to the start of negotiations than the end of negotiations. Does that make sense? So they're just getting a framework where they can begin to talk in earnest.
Okay. Thank you so much. Fantastic context there. And the latest reporting, Stephen Engel and John Liu here on set with us. Right, just ahead, the implications for markets amid greater uncertainty. Well, what else is new? But certainly it is the reality we're in. Julia Wang joins us in a couple of minutes. By the way, for our viewers, any questions for her, send them through. You know how to reach us, of course, for our clients. Plenty more ahead. This is The China Show.
State of play across markets here after 45 minutes of trade. We're seeing not a whole lot of movement, just slightly to the downside when it comes to CSI 300.
It's quiet.
It's quiet, yeah. But then again, it is about the trade headlines. Once again, we talk about unilateral tariffs and the like here. So that is, seeing risk sentiment a little bit risk off here today. So you take a look when it comes to the dollar, though. It's interesting, right? We had that call from Paul Tudor Jones, who came on the show in the U.S. talking about this 10% dollar slump during the next year or so. He still thinks that there's still a lot of legs to this, or at least downside, just given how they're going to have to cut short-term rates dramatically in the next year when it comes to the Fed.
Yeah, if 12 months ago, if someone told me that was in their bingo card this year, the dollar down 15%. But the Fed's not cutting. Yeah, the Fed's not cutting, but everyone else is cutting, and the dollar's down 15%. Like, who would have imagined this is the world we're in? Which is why we are, more normally than than usual, more focused on this 30-year bond option.
Yeah,
let's
bring in Julia Wang, global market strategist at JPMorgan Private Bank. Yeah, a 10% more downside to the dollar. I mean, it seems like there's a lot of more talk about further weakness, but you're thinking maybe things could still stay stable for the dollar.
Yeah, forward. Definitely.
Why so?
Yeah, so thanks for having me on the show. So we think that a lot of the dollar movement so far this year is down 10% since the beginning of the year. Is really a reflection of the worries over the cyclical health of the U.S. economy. And we've seen that through the tariff transmission. That's definitely playing out in terms of our expectation for slower growth. But I think that a lot of that at the edges, of course, there's also compounding, that with cyclical weakness is compounding investors' concern over, I'm already overweight U.S. asset. Do I need to rebalance here and there? Do I need to make some hedges? So that's what's been driving the dollar weaker so far this year. And we think a lot of that cyclical deterioration are somewhere in the price. So yes, we're going to see data weakening, but is it going to weaken more than people are already expecting? And we think there's already quite a bit in the price. But if you think about the U.S. cyclical health of the U.S. economy, we think that there's going to be a floor on it because the fiscal bill will be passed in the next few months, and that will put a floor on U.S. growth 12 months out. So we think the cyclical picture is not going to be as bad toward a 10% deterioration, a weakness in the dollar. On the other hand, if you think through about the longer-term prospect of the U.S. economy, we still think technology is going to be the real driver of growth in this cycle. So balancing these two things out, we think that it's still going to be maybe a more stable environment for the dollar rather than outright meaningful weakness.
Is that the same as saying there's a floor coming for U.S. Treasuries?
I think that to some degree is already playing out, right? You're seeing since the beginning of the rate cut cycle, 50 basis point cut in September 2024, long end yields have actually risen, right? Yes, they retraced a little bit over the tariff tantrum, but as soon as the pause came into effect, you see Treasury yields start rebounding again. So I think that there's quite a bit of inflation and growth and maybe nominal growth support for yields at this point, which is why we think that actually it may be quite hard for long end yield to really fall unless you're expecting a meaningful recession, which is not our base case. So yes, there's a floor, but there may also be a ceiling of some sort because you can see that the Treasury obviously is always very concerned whenever we're breaching about 4.5, and now the expectation for the Fed then comes in. So I think there's going to be maybe also a ceiling. So it's a little bit boring. Could be a range bound
Does that mean? I mean, everyone talks about diversification. Is it just diversification on the margins then? Because last I checked, the dollar is still the world's biggest reserve currency,
and that probably won't change in any short period of time. I do think that to what's worth, I do think that some of the rest of the world opportunities are looking more attractive in this year. Some of that are idiosyncratic. So, for example, the AI breakthrough in China. For example, the Eurozone defense boost to German fiscal room. All of that are happening somewhat idiosyncratically, right? So I think these means that there are more opportunities to draw short-term tactical investors' attention away from the U.S. Definitely there's a competition for that in that space. But I think for longer-term investors, there's we're seeing a very clear consensus that this is going to be an AI age, and that the U.S. is a must-have. U.S. tech, in particular, is a must-have in portfolios. And in fact, their dominance has really only grown over the last 2 years because we see how much of a stronghold the big tech companies really have in terms of the whole AI supply chain and the infrastructure that they will probably have a near monopoly of. So all of that is really only becoming stronger. So we think diversification, yes, for tactical investors, and also if you're looking at other opportunities because you think longer term there will be other growth drivers in different regions. But we're not seeing like a wholesale sell of U.S. equities or U.S. assets.
That's interesting because some people talk about the AI play as an either-or. Either it's U.S. tech or Chinese tech. And, when you talk to your clients, do you get a sense that they're open to both?
I think it's definitely not in either or.
Okay.
I think we get a very strong sense that there are different comparative advantages between U.S. and China when it comes to AI. And the U.S. has very strong infrastructure development capabilities. They have a near monopoly on the technology when it comes to semiconductors, advanced semiconductors. But China, every time I go to China, when we see and hear so many stories about AI applications, be it consumer products, games, videos, everything you can think of, industrial usage. So that means that they're really going down the application route. And there's almost like a frantic race over there. So you can very clearly see that they're both probably going to come out quite strong in this race. And as investors, I think we are taking a very global view on this. And we say that, we like a lot of the AI leaders, be it in US or China, or even some of them on the supply chain in Europe as well.
Broadly speaking, Chinese markets, are doing quite well, especially here in Hong Kong. What's the outlook for the second half?
Yeah, so we're actually still quite constructive in the second half. I think a lot of the rally so far this year is reflecting the AI breakthrough. Companies have delivered on earnings. The macro is becoming more stable. It's not accelerating, but it's stable. Policy have room. So all of that, I think, is been driving the rally. And of course, trade sentiment here and there will shift investors day to day. But it's really the fundamentals that I think is been improving. And on that basis, we still think that the market probably has more to go in the second half of the year. I think that day to day, you will feel the trade sentiment shift back and forth. But it could be actually an opportunity for longer term investors because you will not miss it. It probably will come every time there's a negative headline on trade.
I look across a fund screen, for example, screen. Gold and alternatives seem to top that list year to date.
Yeah.
What is your advice now to clients right now at these levels for gold? And what makes sense cross-asset portfolio? What is the ideal range allocation to something like gold, for example?
Yeah, so I think that gold is really broken with its historical structural drivers, which is the dollar and real interest rates. There's a very meaningful break between gold prices and real interest rate, which is really very rarely happen. And that break occurred in 2022 around the U.S., the Ukraine and Russia war. So we think that what's happened is that central banks around the world are now diversifying into gold. And if you look at composition of demand for gold, that's become a bigger driver over the last couple of years of global gold demand, just in total. It's outweighing the demand on from ETFs, outweighing the traditional demand, from an investment perspective. So that means that there's a very hard floor on gold prices. Is there a small ceiling? Possibly, because it's run up so much. But I think that if you take the view that global central banks still are not stopping or slowing down their purchase of gold, we do think that it can very well reach 4,000 this year.
Wow. Okay, there we go. Julia, fantastic. Thank you so much. Julia Wang, Global Market Strategist at JPMorgan Private Bank. In fact, coming up here, we'll be talking about, so Chow Tai Fook's coming out with earnings later today. That's a gold play if you think of it in some sense. I think, the stock price of Chow Tai Fook is at the closest correlation with gold prices since it became a public company. So maybe that's a story we'll get into, of course, with Macquarie later on, who joins us to talk about Chinese consumer, gold, and everything in between. Plenty more ahead to look at markets. This is The China Show.
Welcome back. Here are some big geopolitical stories that we're following for you today. Rallies against immigration raids that began in Los Angeles have spread to other cities, including New York, Chicago, and Milwaukee, with some clashes reported between protesters and police. In L.A., the downtown area is set to be under curfew for a second night. Tensions remain high, with California Governor Gavin Newsom using a TV address to call President Trump's use of federal powers an assault on democracy. The U.S. has ordered some staff at its embassy in Baghdad to leave, while family members of U.S. military personnel in the Middle East will also be allowed to depart. Statements announcing the decisions did not cite any specific threat, but President Trump told the New York Post he's less confident about negotiations to impose new limits on Iran's nuclear program. Tehran, meanwhile, warned of retaliation if the talks collapse and it comes under attack. The Trump administration has launched a review of the Biden-era AUKUS military pact with Australia and the UK. The Pentagon says it will study whether the deal aligns with Trump's America First agenda as it shifts the burden for collective defense to its allies. The 2021 deal involves the U.S. selling Australia up to 5 Virginia-class nuclear submarines as the allies develop a next-generation sub. UK Finance Minister Rachel Reeves has announced a funding boost for health, defense and infrastructure in a spending review seen as a watershed moment for the Labour government. The NHS will see a 3% rise in spending in each of the next 3 years, amounting to $39 billion. Reeves also confirmed tens of billions of pounds of new funding for infrastructure and public services.
We are renewing Britain. I know that too many people in too many parts of our country are yet to feel it. This government's task, my chance, a task as Chancellor, and the purpose of this spending review is to change that.
Right. A look at quantum computing stocks across the, let's call it across the region here. So you have some in Korea, some in China there. Comments coming through out of Jensen Huang out of NVIDIA talking about how we're at an inflection when it comes to quantum stocks and maybe bringing the technology forward, really leading to gains right now. Speaking of gains here, we're looking at energy stocks across the region up, I believe now for a 7th day in a row here on the actual sector benchmark sub-index. And this is really down to oil. Well, we are seeing that moderate slightly in the Asian hours. We're still up 6-7%, give or take here, across the curve from about, let's call it this time yesterday. Plenty more ahead. This is the China Show.
All right, 11:29 a.m. in Tokyo. Japanese markets heading to that lunch break here right now. And you take a look at how markets are doing there. We're still seeing that downside when it comes to the Nikkei 225. We're down about 0.75%. So stocks are on offer, but there is that sizable strength coming through in the Japanese currency here. We're at 143, just sub 144 levels for the yen here right now, given that sort of haven demand that we're seeing in the face of all these new trade headlines as well. And GGB yields heading lower this morning, Dave.
Yeah, we'll see what that looks like after the 30-year U.S. Treasury auction and what it means for Treasury markets. You know what? There's really nothing much happening. We've been struggling all morning for a headline here. Let's call it flat. Let's call it swinging between gains and losses. What else do we have here? 0.4% to the downside in S&P futures. We're looking at Chinese markets, which I think now all 4 major benchmarks offshore have entered the bull markets. At Hang Seng Index, Hang Seng China, Hang Seng Tech, MSCI China are all now up 20%, and we're seeing a pullback from those levels right now, given, I guess, the lack of positive catalysts, let's call it that. We're flat as well as far as volumes go. A lot of stocks to watch. Horizon Robotics, that's a placement coming through. Shanghai Junshi, which is a regulatory story on monkeypox vaccine. We're seeing a bid across pharma stocks. So to put everything together for us, hopefully, is Sang-Mi Cha, our Asia Equities reporter, to tell us what's going on today.
Yeah, so the closing statement in London was that it's up to the 2 presidents, right? And then President Trump, of course, said it's a done deal as long as President Xi is happy with it. We still haven't heard China sign off on it. So we don't know exactly what's going to happen. But overall, we're seeing that there's this pivot to the risk-on sentiment in the market. So a lot of the traders are just looking to kind of position in some of these Chinese stocks that they have perhaps missed out. We've seen the lowest allocation to Chinese stocks in 5 years. And Morgan Stanley also has said that they have very little positioning in terms of their EM portfolio. So all of this points to more allocation coming in Chinese stocks and Hong Kong, of course. But then today is obviously because it's that wait and see. Again, just not so much of that catalyst coming. So we're seeing a little bit of that profit taking. But again, a lot of interesting opportunities in the market, just like you said, in pharma stocks as well.
Yeah, it seems like every day there's a rally in pharma.
Yeah.
What are you guys focusing on there?
That's right. So for several years, the sector has been struggling with a lot of different challenges, right? It was initially the anti-graft campaign, and then so many of these doubts in the market with clinical trials and so on. But now a lot of people are saying that there's a deep-seek moment in Chinese healthcare and pharma stocks as well, because there are just so many of these innovative drugs, and it's not specific to every company nowadays, but these rallies just continue, and they move in different spaces of pharma. We talk about GLP-1, that's obesity drugs, the PD-1, and a lot of these cancer drugs and so on. There are just so many of these pockets of opportunities in China, and all of this is buoyed by the whole out-licensing deals that's been coming in with the start of Pfizer and 3S Bio.
Okay, Sang-Mi, thank you. Sang-Mi Chad there, our Asia equities reporter, talking about the moves that we're seeing here. Through really what we're seeing in terms of earnings as well. We have one coming up, right? We're talking about Chow Tai-fook.
Healthcare, retail therapy.
Oh, okay. I was like, what?
Where was she going with that?
Oh, yeah, but it's interesting, right? You talk about the stock, 14-month high already, and really at a time when the consumption story in China is still very much in the recovery phase. It's interesting, right? You talked about that correlation between gold prices and this stock in particular. So it's more about a gold play than a consumption play in some ways.
Yeah, because it is. I think it could be the gold play for consumers, right?
Yeah.
Quite literally. So we've actually done a. What is this? Okay, so on the right side is the gold price, and the left is shares of Chow Tai-fook. So we've actually had a look at, I think it's 40-day correlation between the stock and gold prices. It's the closest sustained positive correlation since Chow Tai-fook actually became a public company.
Interesting.
In 2011. But there are other things at play here. Course.
Let's talk just broadly, consumption and the like here, and bring in Linda Huang, head of Asia Consumer Research at Macquarie Capital. She joins us here. Linda, it's been a while. Thank you so much for coming back. Yeah, I mean, obviously this is a gold story in some ways with Chow Tai-fook, but what does it tell you broadly about what the consumption story is looking like in China now?
Yeah, I think right now for this specific for Chow Tai-fook, people probably focus on the gold price, but there's one missing point that the people didn't pay attention to, which is the structure change for the heritage gold. Because in recent years, we see that the heritage gold, they are taking the market share from the so-called gems jewelry, and I think this trend is real because you can see that more and more the international jewelry company, they started to focus on this angle. So for example, in addition to Chow Tai-fook, there's the other listed companies called Laopu. They also bring the sensation in the market for these angles.
Sorry, just for definition's sake, what is heritage gold? Sorry if I'm the one asking in the room what that means.
No, I don't know either.
Or put it simple, if you go to a jewelry shops, right, there are so many like the traditional gold, and everything is based on the daily price, the change price every day. But for the heritage gold, basically, it's much more the part of the hard gold, but the design and it's a talk about the handcraftsmanship, and then they also bring a lot of Chinese culture elements. So for example, they have like a religion cultures inside, and they will have some like a national palace, the culture inside, and they also have some of like the color stone or gems to embed it together, and their pricing is based on a fixed price. So right now you can see it's not like the people in the older generation. Right now it's a young generation. They buy that and they put on their like a daily decoration every day. Okay. So next time you can pay more attention. You are going to see so many.
Yvonne knows what to get me for my birthday now.
Yeah, heritage gold.
Yeah.
Be prepared for that. What tells this whole theme about consumption polarization, this trend that you've been focusing on? What does it tell you about what's happening in the luxury space, mass market, the like right now?
Yeah, I need to say that this the trend still playing out very well because we continue to see that the high-end luxury they are doing relatively good, and then the mass end they also benefit. But I think whatever brand they are positioned in the middle, I think they probably will face certain difficulties for the next coming years because I think that right now the consumer, they are getting more sophisticated. They know that the so-called value for money, and they know that this pricing and then what kind of the product you're offering to me. But in addition to that, I think in recent years, there is also one trend you need to focus on. It's called the experience type of the consumption. So people, they love to go for travel. They love to go for like fine dining. And recently, La Bubu, this trend is also like go crazy around the world. Yes. So I think the consumption behavior become more diversified. It's not just only for merchandising. They want to have something they can have their like fulfillment for their mentally.
I finally opened a Labubu box, and I get it now. I get the excitement and of opening it and getting a surprise. Like I get it.
Do I need to open it to get it?
Boo-boo. Huh?
Do I need to
Yes,
try
I
it to
think we
get it?
should
Because
try
I
to
don't
do
get
it
it.
Let's do it on air. Like, just, you know, I just want you to experience it.
But you see a picture on the boxes, so that's not it.
No.
What's inside?
No.
So there's a fake out.
There's a few you can choose from, and then there's like the secret one.
Okay.
Is the rare one to get. Anyways.
Speaking of, you mentioned luxury is doing well. But we've heard from the European luxury companies that things are not well. So yeah, square that circle for us. What exactly in luxury is doing well?
I need to put this way is that if you're looking for the global luxury consumption, I think there's a big trend is the consolidation. The certain brand they gain the market share. So if you're looking for the first quarter luxury companies, the operation data. Indeed, some company they outperform the market. They still deliver double-digit growth. So for example, Prada, the Q1 grows double-digit. Hermes always a double-digit, right? So they are the market share gainer. And so we started to see that the brand that have a different performance. That's number one. Number two, you can see that consumer right now, they are very smart. Wherever they have the cheaper currency, they travel there and then they go for the shopping. And so you also see that the geographically also have a different performance. But indeed, going to the second quarter, there could be some of the noises. You probably remember that all the tariff happened in April. So the market there are a little bit worried about whether the second quarter the momentum will continue. But I view this as like noises. I think that in the longer term, because you can see the global wealth, also see that the rich people are getting the wealthier, right? So I think they are still the big consumer for the luxury goods. And meanwhile, right now the luxury company, they're doing so well for this so-called VIP management.
You talk about price competition is intensifying. We've seen it in autos. We've seen it in food delivery, e-commerce. Where else in the consumption space are you starting to see really margins being compressed?
Yeah, I need to say that right now this is a competition you mentioned about too, right? But so for example, beverage market, this year we saw that so many companies they launched the lucky draw. You know, I remember this lucky draw 15 years ago. They used to be quite popular, but this year we saw that so many new the company, either new company or the company that launched a new product, they use the lucky draw to grab the attention. So the way they do is that you use the barcode and then you scan, and then if you have like a second bottle for only 1 renminbi. So this is quite pervasive for the beverage market in China right now.
Lucky draw.
Buy 2 for the price of 1.
No, the first one is you need to pay the normal pricing, but the second one, if you are lucky, you can only spend for 1.
Here's the question about bottle. This trend of the great moderation. People are they're drinking less alcohol. How is that showing up in China?
Indeed, I think that the alcohol right now is the most challenging industry. I think you have a multiple reasons, right? Including that I should say the anti-corruption, but there's also related to that. Indeed, the generation they drink less of the alcohol, and so based on the multiple industry we are tracking, this is the industry right now is more impacted by the consumption behavior. So right now we see that the companies they try to change by the different channel. So for example, beer. Previously, maybe the 50% or 60% of the people they drink beer in the on-premise channel. But right now, the beer company they try to push the beer into the off-premise channel, which means that you go to the supermarket, you buy and you drink at home.
Okay. What does that mean for Maotai then? Wholesale prices, are they going to continue to edge lower?
Right now, I think the business activity is less, right? So that's why that Maotai in the near term, they also suffer a little bit from the wholesale price decline. But I think Maotai right now, you can see that it's still the best, the established brand in the baijiu market. And so I think that Maotai right now, they still have ability. They use the less sell-in and to try to secure and maintain support their wholesale pricing. On the other hand, they also push the so-called sub-premium brands, and which they are thinking about there as a group of the consumer. They don't need to drink more than 1,000, 2,000 baijiu, but they are able to afford like a 300 renminbi baijiu, right? So this is where Maotai, they continue to grow their business.
Even moderate when it comes to...
At the end of the day, the hangover is the same anyway.
There is no hangover with Maotai, though. That's the beauty of it.
Yeah. Fantastic, though. I mean that seriously. The times I've had Maotai more than perhaps warranted. I actually don't remember what happened because it was that good.
Okay.
Yeah.
Okay.
You had a question, I think.
I was going to ask, maybe just in terms of a portfolio, then, if I need to construct one on the consumer space, what should I be really kind of focused on? What should I be avoiding?
I think right now we can see these are trends that the investor they pursue for the dividend play, because obviously you have so many uncertainty, right? And a lot of uncertainty is not like the China government they can control. So, for example, we're talking about the trade war, and so the turnout that whoever the company, they can provide a high dividend return, shareholder rewards. This is something that the market they appreciate. So you can see that this 2024, we do see that high share reward companies, indeed, their share price outperform the market. So, for like an investor, this is the sector that I think they can focus on.
Well, what consumer segments are able to still provide
dividends,
predictable dividends given the margin pressure?
Usually, I think the number one is that people, they are looking about the consumer staple, because this is something that you consume every day. And then your demand, suppose, is relatively stable. That's number one. And number two, this is also a sector that have a very strong free cash flow. And as long as you have a strong free cash flow, that means that you can have more cash to reward back to the shareholders.
Fantastic.
Yeah.
Thank you so much.
Thank you.
Linda, we covered everything there. Linda Huang, Head of Consumer Research Asia at Macquarie Capital. Right, just ahead here on shows, Toyota Chairman Akio Toyoda is likely to keep his board seat at today's annual meeting. The details of that just ahead. This is the China Show. Annual meeting today. We're talking Toyota, the automaker, of course, and the gathering of shareholders, and certainly the focus is on the chairman. Akio Toyoda is expected to retain his board seat there, despite concerns over his role in a controversial group company takeover. Let's bring in Reed Stevenson, our senior editor, to talk us through the rationale and why the expectation is, Reed, that he gets to keep his seat.
Yeah, I mean, today's shareholder meeting of Toyota Motor Co. just does seem to be a bit of a non-event, given all the drama we've seen over the past, few months regarding this takeover of Toyota Industries within the Toyota Group. We're about an hour and 45 minutes into the meeting. Kind of a surprise to us. So far, not a lot of the questions have been about this sort of key central issue. But nevertheless, it does seem like, we'll see Chairman Akio Toyoda, of course, the grandson of the carmakers founder, be reappointed, at least in his director's seat.
Those concerns about this takeover, I mean, how do you think he himself is going to be responding to that?
Well, in a way, you can kind of assume that to a certain extent, these shareholder meetings are kind of tightly scripted affairs. And so none of the questions really got into the heart of that matter. And that's really quite a stark contrast to what we saw 2 days ago with Toyota Industries shareholder meeting, which was held possibly for the last time as a public company because of this, privatization bid. And at that meeting, virtually all the questions were about this proposed deal. And in fact, it was like the longest meeting ever in the company's history.
Perhaps they got all the answers there. I don't know. We'll see. Reed, thank you. Keep us updated what's going on. Reed Stevenson there, our senior editor, joining us out of Tokyo. Some other big corporate stories that we're following for you today. Oracle shares jumped in late trade after it projected cloud infrastructure sales will expand more than 70% this fiscal year. It's spending heavily to build and equip data centers globally, with CapEx of about $25 billion expected this year. Oracle is part of the Stargate joint venture announced this year with OpenAI and SoftBank. China's top steel industry group is warning that the ongoing EV price war is squeezing mills and worsening their financial troubles. The China Iron and Steel Association says some automakers have asked steelmakers to cut prices on vehicle-grade steel sheets by over 10% since last year. China's electric vehicle sector is in a period of intense price competition. We got plenty more ahead. This is Bloomberg. The Pentagon has announced it will review the AUKUS military pact to see if it aligns with the Trump administration's America First policy. The $240 billion agreement would see Australia receive U.S.-made nuclear-powered submarines to replace its aging fleet. Let's bring in Paul Allen. He has more on this story. And Paul, is this deal really at risk now?
It's very hard to say at the moment because, of course, the White House has such a reputation now for being unpredictable and unorthodox. But we have heard from Australia's Defence Minister, Richard Marles. He's quite relaxed about this, saying, look, it's quite natural for a new government to want to review something of this scale. And we heard from the UK's Prime Minister, or not the Prime Minister, but the UK government, saying, look, when Keir Starmer became Prime Minister last year, they also conducted a review of the AUKUS pact, so nothing to see here. What we do know is that the Pentagon asked for this. The review will take about 30 days. It's going to be headed up by Elbridge Colby, the Deputy Defence Secretary. He does have a reputation as being an AUKUS skeptic, but on the other hand, during his confirmation hearing, he wanted to cut red tape, streamline processes. The US also wants its allies to spend a lot more on defence commitments. So the AUKUS pact does achieve a lot of those goals.
And I'm guessing if China's looking at this sort of headline that this deal is at risk, they could be rejoicing at all of this, right? I mean, does this AUKUS satisfy the whole America First policy?
Well, that's the thing. In many respects, it does. Australia is among a number of US allies that's been asked to up its defence spending, and it's going to spend hundreds of billions of dollars on AUKUS over the coming decades. This is a decades-long commitment. Australia's already delivered $500 million to get the ball rolling. It intends to buy between 3 and 5 nuclear-powered submarines off the US. There will be significant investments in US submarine production as well. So it would seem a little bit unusual for the United States to turn its back on all of that. Certainly Keir Starmer, the UK Prime Minister, after conducting its review, said, look, AUKUS is the centrepiece of UK defence strategy for the coming decade. So for the US to turn its back on that would be a very impressive rug pull, and perhaps one that's hard to understand as well. But the review set down for 30 days. We'll see what it brings. In the meantime, the Australian Prime Minister Anthony Albanese will have his first face-to-face meeting with Donald Trump during the G7 meeting. So I guess you can add this one to the list of things that Albanese and Trump will have to talk about.
Yeah. Paul, thank you. Paul Allen there in Sydney for us. Just to, okay, I'm looking at some news. I will talk about this news in a moment here. Just very quickly, we're looking at the Kospi Index. So the highest close since 2022. We're extending that. So it's, yeah, K-pop, right? And it's not just the young crooners at BTS that are
oh, yeah, they're
coming back out in the wild.
Ah.
Right?
Oh, man. That's going to be very interesting.
I did see some pictures, though. I don't know them individually, I have to say.
Okay, we'll talk about that.
There's a Jungkook fellow, isn't there?
Yes, there's many more. Okay, before we go, we got to talk about this breaking news. So Toyota shareholders in the AGM had voted to reappoint the chairman, Akio Toyoda, which is what Reid basically mentioned, that this was basically something that was not a surprise right now. What is a surprise is that there hasn't been that much talk about this whole Toyota Industries buyout, right, which led to a lot of backlash and concerns from shareholders. It looks like in terms of the questions, we haven't seen anything discussed just yet, but we'll get you a little bit more details once we get them there. But yes, for now, Akio Toyoda, though, sticking with his seat and his job right now. In the meantime, let's get you caught up with how markets are doing, because you take a look at how Hong Kong markets have been doing. I mean, it's been doing so well that, you know, we got to talk about this AH share premium, which is basically now not much of a premium, actually.
It's the lowest in 5 years now because of the outperformance we're seeing here in Hong Kong. The yellow line effectively represents the 10-year low, and as you can see, that tended to be, and that's past tense now, that tended to be a level at which the Hong Kong rally faded, and then it became sort of a paired trade in the favor of A shares, which is the onshore listing. But as you can see now, that rally has now taken this premium, still a premium, but now to the narrowest in about half a decade here. So yeah, I guess something to consider as we make our way into the thick of last day of the week. Is it Friday?
Well, at least for me.
Oh yeah. So she'll see you on Monday. I'll see you all tomorrow.